They laughed when I said Taco Bell could be a 10-bagger. I didn't blame them. Back then, the company was a handful of Mexican-themed shacks selling tacos to people who didn't know what a taco was. It was the 1970s, the dark age of fast food investing. Everyone wanted to own the big guys. McDonald's, Burger King, maybe Wendy's if they felt adventurous. Taco Bell? Too weird, too small, too risky. But that's the funny thing about 10-baggers. They never look like 10-baggers when you buy them. They look like a punchline. I found Taco Bell the way I found most of my winners, by turning over rocks. I didn't read about it in the Wall Street Journal. I saw it in real life, cars lined up around a drive-thru, people leaving happy, and, most importantly, a line at the cash register. That's my kind of research. No computer models, no consultants, just a pair of eyes and a working brain. When I started digging, the numbers were almost boring. That's how you know something's good. Simple business, low cost, growing fast. They were expanding stores without borrowing much money, which, on Wall Street, is considered unthinkable. The analysts hated it. They said, Peter, Mexican food is a fad. I said, so is breathing if you wait long enough. Here's what most investors miss. The story matters, but the math matters more. And Taco Bell's math was beautiful. A store cost $250,000 to build. It made about $100,000 in profit. That's a 40% return on investment before anyone even talked about franchising. Meanwhile, the stock sold for less than 10 times earnings. That's like buying a goose that lays golden eggs and everyone else saying, nah, I don't like the color. I didn't buy because I liked tacos. I bought because I liked economics. Taco Bell didn't need fancy chefs or expensive decor. They sold the same few items, fast, cheap, and consistent. If you can make one store work, you can make 100. And if you can make 100 work, congratulations, you found yourself a 10-bagger. Most people don't realize how much emotion gets in the way of logic. When something looks too small, they ignore it. When it starts to rise, they call it too expensive. And by the time they finally believe in it, the 10-bagger's already gone. That's why I say, the best stock you ever buy won't make you comfortable when you buy it. When I invested in Taco Bell, it wasn't because I had a vision. It was because the facts lined up. Strong growth, real profits, a product people liked. That's it. No rocket science, no macro forecasting. Just common sense, which, on Wall Street, is the rarest commodity. Years later, when the stock had gone up 10 times, people said, Peter, you must have known it would be huge. No. If I knew, I would have bought more. What I did know was that it was a simple, profitable business with room to grow, and that's all you ever really need. Investing, to me, was never about predicting the future. It was about recognizing the present before everyone else did. I saw a company serving food people actually wanted in a way they could afford. I saw a business model that worked in one town and could work in 50. And I saw analysts too busy reading reports to notice what was happening in the parking lot. That's the edge, not IQ, not algorithms, just observation. If you want to find your own Taco Bell, stop reading what everyone else is reading. Start looking where no one's looking. Buy what you understand. Ignore the noise. And remember, if you spend 13 minutes a year on economics, you've wasted 10. Because in the end, the secret wasn't that I found Taco Bell early. The secret was that I believed my own eyes. And that's where every 10-bagger begins. Not in a spreadsheet, but in the real world. Behind every great stock is a great company. And behind every great company is a simple story that makes sense. Every time a stock doubles, the same course begins. It's too late now. I heard that line about Taco Bell so often I could have printed it on a t-shirt. When the stock went from 7 to 14, people said, you missed it. When it hit 28, they said, it's overpriced. When it passed 50, they said, you're lucky. That's Wall Street for you. Everyone wants a bargain, but no one wants a winner. Here's the truth. You're never too late to buy a great company if the story's still good and the numbers still work. You're only too late when the business runs out of room to grow. Taco Bell kept opening stores, kept making money, and kept proving the skeptics wrong. But the market doesn't reward patience, it rewards panic. So most investors kept looking for the next undiscovered gem and missed the one still compounding right in front of them. I've watched this movie 1,000 times. Someone sells a 10-bagger after it doubles because they want to lock in profits. Then they watch it double again without them. That's not investing. That's financial self-sabotage. Let me tell you a story from the 1980s. I met an investor who bragged about buying Taco Bell at $7. He sold it at $9, made 28% in a few months. He thought he was a genius. Years later, he told me, Peter, that stock went to 70. I missed the boat. I said, you didn't miss the boat. You jumped off it. People love to say, no one ever went broke taking a profit. Actually, plenty have, they just do it slowly. They sell every winner early and hold every loser forever. They prune the flowers and water the weeds. It's a human problem, not a math problem. Our brains crave certainty. Our stomachs hate volatility. And the combination makes us do exactly the opposite of what works. Here's what works. When you find a good company, one that's growing, profitable, and not priced like a fantasy, you hold it until the story changes. Not until you get bored. Not till it stops going up. Until the reason you bought it no longer applies. That's the discipline. For Taco Bell, the story was simple. Open more stores, keep margins high, make customers happy. As long as they kept doing that, I stayed put. And while everyone else tried to guess the next hot thing, I let compounding do the heavy lifting. The biggest gains come not from brilliance, but from duration. You don't need to catch every bottom or top, you just need to stay on the train long enough. But most people can't do that. They get itchy fingers the moment a stock rises. They think they're being smart by selling early. Smart? Maybe. Foolish? Never. One of my favorite lines is, the stock doesn't know you own it. It doesn't care what price you paid or what return you want. It'll go up or down based on the company's performance, not your feelings. And yet, half of investing decisions are based on feelings. Fear of missing out. Fear of losing what we've gained. Fear of looking stupid. You can't invest well if you're always trying to protect your ego. When Taco Bell became a market darling, analysts who once laughed at it started issuing buy ratings. That's usually when you know the easy money's gone, not because the stock's high, but because the crowd finally agrees with you. But by that point, my gains were locked by logic, not luck. I didn't chase new names to look clever. I just stayed with what worked. It's not exciting, but neither is watching paint dry, and both can make you rich if you wait long enough. Every investor should remember this. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. You can't compound if you keep interrupting compounding. So next time you're tempted to sell because the stock doubled, ask yourself one question. Would I buy it today if I didn't already own it? If the answer is yes, don't sell. You're not too late. You're just getting started. Owning a stock is like owning a business. If it keeps growing, don't trade it, treasure it. Everyone wants to find the next 10-bagger. Few are willing to do the work that finds them. People think I had some secret formula. I didn't. I just looked where others didn't in the parking lots, strip malls, and suburbs of America. If you wait for Wall Street to tell you what's hot, you're already too late. By the time analysts notice, the easy money's been made. The edge comes from observation, not information. You don't need insider tips. You need curiosity. I used to walk through shopping centers with my wife. She'd buy something new, and I'd ask, is everyone else buying this too? That's how I found companies like Hanes when they launched Legs and La Quinta Inns. The best research is done with your own 2 feet. With Taco Bell, it started the same way. I saw long lines, fast service, and a low-price menu that made teenagers happy and franchise owners richer. No one needed to explain that story, it told itself. If you can summarize the investment case in one sentence, you might be onto something. If the company keeps expanding like this, earnings will double in a few years. That's napkin math, and that's all you need. Wall Street calls this scuttlebutt. I call it common sense. If you wait for the quarterly report, you're reacting. If you watch what's happening in real life, you're predicting. When Polaroid was booming in the 1960s, everyone could see it, kids snapping instant photos everywhere. When it started losing relevance, everyone could see that too, except the analysts who never left their offices. The market rewards people who notice reality first. So how do you spot the next Taco Bell? Start small. Look for companies that dominate a niche, not the whole world. A chain that wins in one city can win in 50. A product that delights one group of customers can capture 10. Don't look for the next Microsoft. Look for the next Dunkin' Donuts. That's how 10-baggers are born, quietly, locally, and invisibly to the experts. And here's a trick. If a company is expanding and the story is still under the radar, pay attention to the boring details. Are profits real? Is debt manageable? Are insiders buying their own stock? Those are the little signals of big potential. Because great companies don't scream genius, they whisper steady. Let me tell you a rule. If you like the store, chances are you'll love the stock. But you can't stop there. You still have to open the annual report and do some fifth-grade arithmetic. How fast are earnings growing? What's the price-to-earnings ratio? Does it make sense that the market hasn't caught up yet? If the math and the story agree, you've found a candidate. A true 10-bagger has 3 traits. 1, simple business model. You can explain it to a 12-year-old. 2, long runway. Still small enough to keep expanding. 3, emotional resilience. You can hold it when it drops 30% and still sleep at night. Most investors fail on the third one. They want the 10-bagger, but not the drawdowns that come with it. They want to get rich slowly but feel good instantly. That's not how compounding works. When I owned Taco Bell, it didn't go up in a straight line. It fell, recovered, fell again. Each drop tested my stomach more than my brain. But the business didn't change, only the mood did. And moods don't make money. Business do. If you want to beat Wall Street, don't try to outsmart it. Out-observe it, outweight it. Outbelieve your own homework. Because the truth is, most people never find a 10-bagger, not because they're unlucky, but because they never notice what's right in front of them. The person who turns over the most rocks wins the game. You don't need perfect timing. You need relentless curiosity. Wall Street loves complexity. They can't sell simplicity. There's no fee in common sense. If you walk into a brokerage office and say, I'm buying a company that sells tacos, they'll look at you like you've lost your mind. But say, I'm investing in an emerging markets derivative arbitrage fund, and suddenly you're a genius. That's how people lose money, by confusing sophistication with success. The best investments I ever made were boring. Dunkin' Donuts, Pep Boys, Taco Bell. No glamour, no buzz, just cash registers that rang all day. Meanwhile, the companies that sounded exciting, lasers, electronics, space-age nonsense, most of them ended in tears. It's amazing how many investors will buy a company with zero earnings just because it makes them feel smart. You can't eat earnings projections. You can't pay bills with potential, but you can get rich from a business that sells 1 million tacos a day. People forget that behind every stock symbol is a business. Real people, real stores, real customers. If you can't find those, you don't have a business, you have a story. And Wall Street sells stories for a living. When I ran the Magellan Fund, analysts would pitch me these elaborate ideas. Graphs, models, buzzwords, all perfectly polished nonsense. I'd ask, does the company make money? They'd say, not yet, but it will. Translation, it's a hope, not an investment. I remember one pitch about a company making laser-guided industrial widgets. It had patents, projections, and PowerPoints. I asked the analyst, how many do they sell? He said, none so far, but they're in talks with a major buyer. Meanwhile, Taco Bell was opening 3 new stores a week and turning a profit at each one. Guess which stock I wanted? The tacos beat the lasers every time. Investors chase complexity because it flatters the ego. No one wants to admit they got rich on burritos. They want to sound intellectual at dinner parties. But money doesn't care how clever you sound. It only cares whether the business earns more next year than it did this year. That's the math that matters. Here's my test for any investment. Can you explain it to a 5th grader? If you can't, you probably don't understand it yourself. And if you don't understand it, you'll panic the first time it drops. Complicated stories collapse under stress. Simple ones survive. When the economy turned south in 1982, all those high-tech disruptors vanished. But people still bought tacos, donuts, and car parts. The companies that look dumb turned out to be the smart ones. Investing isn't about finding what's new. It's about finding what's durable. Products people will still want 10 years from now. Services that don't depend on magic. That's why I never got tired of repeating, never invest in anything that can't be explained with crayons. Because crayons and tacos will still be around long after Wall Street moves on to the next big thing. When I bought Taco Bell, no one called it innovative, but it was quietly revolutionizing fast food. Standardized menus, franchising power, scalable economics. You didn't need a PhD to see it, just a lunch break. And yet, the crowd missed it because it was too simple to seem impressive. That's the irony of markets. The simple things work, but they don't feel smart enough. The complex things fail, but they make you feel brilliant while you're losing money. If you can resist the urge to be clever, you'll beat 90% of investors. The simpler the story, the better the stock. If it takes more than a paragraph to explain, move on. Owning a 10-bagger sounds glamorous. It isn't. It's a test of your stomach, not your brain. Everybody wants to ride a stock up tenfold. Nobody wants to sit through the 50% drop that comes halfway there. When Taco Bell took off, the story didn't go in a straight line. In the early 80s, inflation was running wild, interest rates were through the roof, and every headline screamed recession. Fast food stocks plunged. Analysts called me asking if I was selling. I said, why would I? People don't stop eating tacos in a recession, they just trade steak for tortillas. But that's not how fear works. Fear doesn't ask questions, it just sells. I watched Taco Bell fall 30% in a few months. On paper, that's a disaster. In reality, the business was doing fine. Earnings kept rising, stores kept opening, customers kept showing up. So I did what every investor hates to do. I did nothing. The hardest part of investing is not knowing what you own. When you don't understand a company, every dip feels like the end of the world. When you do, every dip feels like a sale. Owning a stock is easy when it's going up. The real work begins when it isn't. That's when you find out whether you're an investor or a collector of ticker symbols. There's an old saying, markets climb a wall of worry. That's not poetry, that's experience. Every month there's a new reason to panic. Oil, shocks, wars, elections, recessions, interest rates, bubbles, pandemics. And every time people swear this time is different. It almost never is. When you've done your homework, you don't need a crystal ball. You just need conviction. You can't predict corrections, but you can prepare for them. And the best preparation is owning good companies you actually understand. That's what kept me calm during the crashes. While others were glued to CNBC, I was reading quarterly reports. Numbers, not noise. Here's something I told Magellan investors back then. If you can't handle seeing your stocks drop 50% without panicking, you don't belong in the stock market. It's harsh, but it's true, because every 10-bagger will test your nerves before it rewards your patience. When I bought Taco Bell, I didn't buy because I thought the stock would never fall. I bought because I believed the business would survive every fall. That's a huge difference. Investors think volatility equals risk. It doesn't. Volatility is just noise, risk is not knowing what you own. I once met a man who sold all his stocks in 1987, right before the crash. He was so proud of his timing, but he never got back in. He waited for the right moment. The right moment never came. Meanwhile, Taco Bell recovered, tripled, and kept going. He protected his ego, but missed the compounding. That's the curse of market timing. You can be right once, but you have to be right twice when you sell and when you buy back. I'd rather be mostly right and permanently invested. To survive the panic, treat stocks like businesses. Would you sell your store just because fewer customers walked in this week? Of course not. You check your product, your costs, your cash flow, and adjust. The same logic applies to owning shares. If the fundamentals are intact, stay put. When the market crashes, remember, someone's selling you their fear and paying you for the privilege. That's when 10 baggers get handed from weak hands to strong ones. In the stock market, the stomach is more important than the brain. If you can't handle a 50% decline, you'll miss the 500% gain. If you want excitement, go to Vegas. If you want wealth, buy boring. The stock market is full of people chasing fireworks, the next tech boom, the next biotech miracle, the next electric whatever. Meanwhile, the real money quietly piles up in companies selling diapers, paint, and tacos. Boring pays. When I ran Magellan, my biggest winners weren't the flashy names. They were companies so dull, nobody wrote about them. That's the beauty of boring, no competition from the crowd. Wall Street doesn't want dull stories. Analysts can't write 30-page reports on company keeps doing the same thing well. But that's exactly the kind of headline that should make you buy. Let me show you the math. Say you buy a company growing earnings at 15% a year. Not spectacular, just steady. In 5 years, profits double. In 10, they quadruple. And if the market still hasn't noticed, that's your 10-bagger hiding in plain sight. You don't need a miracle. You need endurance. Taco Bell wasn't exciting. They didn't reinvent food. They just made it faster and cheaper. But that predictability, that dull, repetitive efficiency was their moat. Every franchise sold the same tacos, used the same equipment, trained employees the same way. That's not innovation. That's discipline. And discipline compounds better than hype ever will. People overlook boring because it doesn't feel like progress. They think investing has to be dramatic to be meaningful. But investing is not supposed to entertain you. It's supposed to make you rich. Every day, I get calls from investors wanting something exciting. I tell them, excitement is what costs you money. You know who loves boring companies? Time. Because time compounds consistency. An exciting stock might double fast and collapse faster. But a steady compounder doubles, then doubles again and again without anyone noticing. 10 years later, people call it luck. No, it was boredom with a bank account. There's a paradox here. The more predictable the business, the more unpredictable the returns look to outsiders. Because no one expects the dull to outperform the dazzling. They forget that while investors are busy chasing fads, someone has to keep the lights on and the world fed. That's where boring lives in the real economy. Let me tell you a story. In the 1970s, I looked at Pep Boys, the auto parts retailer. People said, why bother? It's just car tires and oil filters. Exactly. People will always drive cars. Cars will always need repairs. That's not sexy, but it's forever. Pep Boys wasn't going to make headlines, but it was going to make profits. That's how you find stocks that survive decades, not seasons. Investors crave novelty, but markets reward repeatability. If a business can produce the same reliable cash flow year after year, you can build empires on that foundation. The trick is having the patience to let dullness work its quiet magic. When you look at your portfolio, ask yourself, would I rather own something that sounds clever or something that pays me quietly for the next 20 years? Choose boring. Boring doesn't brag, but it compounds. The more boring the company, the better I like it. Because boring is predictable and predictable is profitable. The stock market runs on two fuels, greed and envy. Fear gets all the headlines, but envy does most of the damage. Every investor knows the feeling. You're sitting on a nice, steady gainer, maybe up 40%, and then you watch your neighbor brag about a stock that doubled last month. Suddenly, your boring winner feels like a mistake. That's when smart people start doing dumb things. When Taco Bell became one of my 10 baggers, people assumed I was some fearless genius who never doubted. Not true. I doubted all the time, but I didn't act on the doubt. Because I learned something watching investors for decades. Most don't lose money because they buy the wrong stock. They lose it because they can't stand watching someone else make more. Envy makes investors chase what's already gone. They dump the slow, steady growers to buy the hot, shiny rockets. Then the rockets crash and they crawl back to the steady stocks right before those take off again. They don't compound wealth, they compound regret. It's an endless cycle of could've, should've, and next time. The irony? The person you envy probably envies someone else. It's a daisy chain of misery, stretching from Wall Street to Main Street. That's why I always told investors, the key organ in investing isn't the brain, it's the stomach. Because envy is a stomach problem. It makes you nauseous when someone else wins. It makes you restless when your own money is quietly compounding. You can't think straight when you're busy comparing. Let me give you an example. In the early 1980s, everyone wanted to own technology stocks. Apple, IBM, digital equipment, the future. Meanwhile, Taco Bell was selling tacos, same as always. The tech stock soared and then crashed. Taco Bell kept opening stores. Guess which one made more millionaires? The one no one bragged about at cocktail parties. FOMO, the fear of missing out, is just a fancy way of saying, I can't stand being patient. But patience is the price of compounding. And compounding is the only free lunch on Wall Street. If you can't wait, you can't win. When you own a great company, the worst thing you can do is sell it just because someone else's stock is moving faster. It's like leaving your spouse because your neighbor's getting a new car. Envy makes people trade perfectly fine businesses for temporary excitement. They forget that every time they switch, they're not just changing stocks, they're restarting the compounding clock. I've seen investors sell 10 baggers halfway through the journey because they got tired of watching something else go up more. That's like quitting a marathon at mile 13 because someone sprinted past you. The race isn't short, it's lifelong. Here's a truth that's hard to swallow. You'll always miss some winners. That's fine. You don't need to own them all, just a few good ones. Long enough. Taco Bell was one for me. There were others I missed entirely. I didn't lose sleep over it. Because I knew one 10-bagger makes up for 50 misses. You don't have to swing at every pitch. You just have to avoid striking out on your own good ideas. So the next time someone brags about their next big thing, smile and nod, then go back to your steady compounders. You're not playing their game, you're playing yours. People spend more time worrying about the stocks they missed than the ones they blew up. Stop counting other people's gains, they don't pay your bills. Selling is the hardest part of investing, not buying. Buying feels exciting, selling feels like confession. Everyone wants a formula for when to sell. There isn't one, but there are a few good reasons and a mountain of bad ones. Let's start with the bad. Bad reason has own. The stock's gone up a lot. That's not a reason, that's a description. If the company's still growing, earnings are rising, and the story's intact, why sell? Because it's higher? That's the goal, isn't it? Selling just because something went up is like firing your best employee for showing up early. Bad reason #2. Everyone's talking about it. The crowd doesn't know what you know. They know headlines, numbers. By the time everyone notices, you should already be sitting on a profit, not running for the door. Remember, popularity doesn't kill a stock. Overvaluation and slowing fundamentals do. Popularity just makes you nervous. Bad reason #3. I want to take profits. Translation: I don't trust my own homework. If you truly understand the business, you won't need to lock in anything. You'll let it ride as long as it earns more each year. Taking profits is the investor's version of cutting the flower because it's finally blooming. Now, the good reasons to sell are fewer but simpler. Good reason, Hasson. The story changed. When Taco Bell's growth story ended, when the expansion slowed, margins peaked, and saturation set in, that's when I started trimming. The magic wasn't gone, just matured. If the reason you bought it no longer exists, sell it. Not because of emotion, but because of logic. Good reason, #2. Management lost the plot. I've seen companies with great products destroyed by executives who thought they were smarter than arithmetic. Ego kills margins faster than competition. When management stops acting like owners, it's time to leave. Good reason #3. There's a better opportunity you understand equally well. Selling one solid business for another is fine, but only if the second one's story is just as clear, not just newer. Otherwise, you're swapping conviction for curiosity, and curiosity doesn't compound. Here's the rule I live by. Know why you bought it. Know what would make you sell it. Write both down. Everything else is noise. When the noise gets loud, the market crashing, the news screaming, the analysts panicking, go back to that note. Has the reason changed? If not, sit tight. During the 1987 crash, Taco Bell dropped hard like everything else. I didn't sell a single share. Why? Because the restaurants were still full. They didn't close the doors just because the Dow fell 500 points. The business didn't know the market was scared, and neither should the investor. Selling is emotional because it feels final. But investing isn't about closure, it's about progress. You're not trying to win arguments, you're trying to let compounding do its work. Every premature sale cuts your own engine short. Here's what I told my fund investors. Time is on your side when you own good companies. It's your enemy when you trade them. The stock market transfers money from the impatient to the patient, and selling too soon is just impatience in a nice suit. So, when should you sell? When the business story ends, not when the stock story changes. Everything else is just noise disguised as wisdom. If you can't explain why you own it, you shouldn't. If you can explain why you sold it, make sure it isn't fear talking. Wall Street talks about risk like it's a math problem. They'll show you charts, standard deviations, betas, and Sharpe ratios. None of them ever helped anyone sleep better at night. Because real risk isn't a formula, it's a feeling. It's waking up at 3 a.m. and wondering, do I actually know what I own? If the answer is no, that's risk. When I owned Taco Bell, the experts told me it was risky. Small company, fast food industry, low margins. They said, Peter, it's not diversified. I said, neither is McDonald's, and they seem to be doing fine. The truth is, you can make a risky stock safe by understanding it. And you can make a safe stock dangerous by buying it blindly. Knowledge doesn't eliminate risk, it redefines it. Real risk is buying something you don't understand. It's owning a company whose future you can't describe in plain English. It's investing in a theme instead of a business. Every time someone said, this stock can't miss, I made a note it usually did. The market loves to sell safety funds, hedges, diversification strategies, all to protect you from your own ignorance. But there's no substitute for actually knowing what you own. The safer your understanding, the less you'll need insurance. In the 1980s, people called utility stocks safe. They had stable dividends, predictable cash flows until interest rates soared. Suddenly, they weren't safe anymore. Meanwhile, Taco Bell, supposedly risky, was doubling earnings every few years. So which one was riskier? The one that couldn't adapt? That's what people forget. Risk isn't volatility. Risk is permanence of loss. Volatility is just the market having mood swings. Risk is when the business breaks and can't recover. If the business is sound, price swings are just opportunities in disguise. Let me give you a rule. The biggest risk isn't losing money, it's losing conviction. Because once conviction's gone, the next headline will scare you out. And when you sell out of fear, you don't just lose money, you lose your edge. Here's how I measured risk at Magellan. Could I explain the business on one sheet of paper? Could I see its growth path for the next 5 years without magic assumptions? Could I sleep at night owning it through a 50% drop? If the answer to all three was yes, that was low risk. Everything else was speculation dressed as strategy. Markets have a funny habit. They make the simple sound naive and the complicated sound intelligent. But the complicated ideas are the ones that blow up spectacularly. Long-term capital management proved that. Brilliant PhDs, perfect models, and one bad year later gone. They knew everything about volatility and nothing about humility. Taco Bell didn't have quants. It had customers, and customers are a more reliable predictor of success than any spreadsheet ever printed. That's why my definition of risk was always rooted in observation, not equations. If the parking lot's full, the tacos are cheap, and the franchisees are making money, the risk is low, no matter what the market says. Wall Street's favorite illusion is control. They think if they can measure risk, they can eliminate it. But the only control you have is discipline. You can't control the market. You can't control the news. You can control whether you buy what you understand and hold it when others panic. That's real risk management, and it fits on a napkin. Volatility is not risk. Ignorance is. If you know what you own and why, the rest is just noise. Every investor wants to find the next Taco Bell. Few are willing to believe in it when it looks small, strange, or unpopular. That's the paradox of great stocks. They never feel great when you buy them. They only feel obvious in hindsight. When I first bought Taco Bell, the charts didn't look pretty. The P divided by E ratio wasn't screaming cheap. The headlines weren't glowing. There was no grand theory behind it, just a business that made sense to a guy who liked arithmetic and lunch. The lesson? You don't find 10 baggers on paper. You find them in reality by watching what people actually do with their wallets. Every investor talks about conviction, but conviction isn't built in your head. It's built in your gut. Because when a stock drops 30%, your spreadsheet won't comfort you, your understanding will. If you truly know what you own, fear turns into opportunity. If you don't, fear turns into panic. That's why I always said, the key organ in investing isn't the brain, it's the stomach. Brains overthink. Stomac endure. And endurance is where compounding lives. Charts show you what happened. Your gut tells you what matters. Wall Street loves to sell precision models, forecasts, targets, but precision is an illusion. You can't forecast human behavior with decimals. What you can do is recognize patterns. People keep eating. People keep driving. People keep needing convenience. That's why the simplest trends make the biggest fortunes. Taco Bell wasn't about tacos. It was about scale. A system that could replicate itself across the country with the same price, same taste, same speed. That's not food, that's engineering. And the stomach for holding it through every dip? That's not luck, that's discipline. Here's the irony. Most investors think the secret to wealth is finding something brilliant. It's not. It's staying with something obvious longer than anyone else can stand. 10 baggers reward patience, not prediction. They test your nerves before they reward your faith. They look stupid before they look smart. Every time I made money in stocks, it wasn't because I knew what the market would do next year. It's because I knew what the business could do in the next 10. That's the difference between trading headlines and owning progress. Investing isn't about being clever. It's about being consistent. Here's what I tell young investors now. Forget the screeners. Forget the chatter. Go outside. Look around. See which businesses are winning the daily battle for customers. If you spot it early, understand it fully, and hold it patiently, congratulations. You're doing what 90% of investors won't. You don't need perfect timing, fancy math, or Wall Street approval. You just need the courage to believe what you see and the stomach to sit through the noise. That's how Taco Bell went from a weird little fast food idea to a 10-bagger. Not because of luck, but because of logic and patience. So the final rule is simple. Big money is made in the waiting, not the buying. Anyone can spot a winner for a day. It takes conviction to hold it for a decade.